Thanks so much for tuning in to this earnings conversation with Mr. Anil Rai Gupta. Relative to the expectations that the market had, the numbers came in a bit soft, though I must say the margin expansion was a bit heartening. But the ECD segment, presumably because of the festive season shift from 2Q to Q3, was a bit lower than consensus. Mr. Gupta joins in to talk about how he thought of the first half, if you will, not just Q2, and what does this mean for the second half? Mr. Gupta, great having you. Thanks for taking the time out. Put this into perspective, sir. What did quarter two shape up as per your expectations? Because the street, I think, had slightly higher estimates relative to what's been reported.
Yeah, so we've seen, we were expecting a better consumer offtake during the second quarter. So we've seen the consumer offtake in the last 1 year since the inflation started creeping up, the prices started going up. There had been a soft pickup in the consumer sector, and that has continued to some extent in the second quarter. Though in the last fortnight of the second quarter, we started seeing some better pickup. But, if you were to ask me on the consumer side, it was definitely below my expectations. On the industrial side, which is 30% of our business, that continues to show strong growth in professional luminaires, industrial switchgears, industrial cables. So that's doing well. The disappointment, what I would say, is the consumer offtake in the second quarter. But I think with the third quarter coming up, the festive season actually moving to the third quarter as against the second quarter last year, we should see better growth in products like lighting, consumer appliances, water heaters, and of course, going into the second part of the second half, we should see summer products starting doing well also. Because last year, summer products were also not very good because of the intermittent rains. So I think second half, I'm quite hopeful that even the consumer demand should start picking up. And of course, the festive season, summer demand should also augur well for the growth of the organization.
Different kinds of organizations catering to different kind of consumers. Mr. Gupta, in the last 6 months have cited very different idiosyncratic reasons for the inability to be able to correctly predict what could happen to the Indian consumer demand. Is it becoming very difficult, very segmented for companies to try and guesstimate how and when would consumer demand really pick up?
Yeah, actually, sometimes you get forced by the TV channels to actually predict. But frankly, the fact is it's very difficult to predict. And the reality is that, markets are dynamic now, much different than what they were earlier. Today, India is also affected by the global, sentiments, global, things which are happening. So we are not completely isolated, and hence it's becoming difficult to predict. But also, it's actually fun to operate in such an environment, and it gives you a competitive edge if you are a flexible organization, an agile organization. You can adapt to situations differently, and we've actually tried to maintain that agile and entrepreneurial culture in Havells, and we actually thrive and enjoy in this kind of a situation.
Okay, guilty as charged. Yes, at times we do force people to predict when it might be very difficult. Just trying to understand, Mr. Gupta, the other aspect that I wanted your perspective on, because I saw there is a margin expansion. Of course, it's a quarterly phenomenon, so I won't dwell too much into it. But what we've observed in the last 2 or 3 sessions is because of the geopolitics or otherwise, shipping costs, transportation costs, freight costs, etc. have moved up. Indian crude basket at some point of time will also become more expensive than what it would have been in the quarter gone by. Is this a worry for what is arguably going to be a busy season?
Overall, in the last 6 months, actually, the raw materials have started abating, and that's a good sign because, if you remember last year when they were going up, copper, aluminum, steel, plastics, they were going up. The companies, including ours, we could not pass on the entire cost to the market because it was unprecedented increase.
Yeah.
In fact, now when things have started settling down, we are trying to come back to our normalized margin levels. So that's why we see a little bit of a margin expansion, and hopefully that should continue to, if not, be at very high margins, but at least to be at normal margin levels. So I think in the next 6 months, we'll see more of that. For us, it's more of raw materials, which is the thing, which is actually, thankfully, not as volatile as it was a year and a half back.
Got it. So for the second half, if you will, because one quarter might be difficult, but I'm just trying to understand. You recorded a decent expansion in quarter 2 YOY. You reckon these are levels that could be maintained or improved upon?
Yes, that's what I meant. That with the materials now not under a very fluctuating mode, I think we should see maintenance or expansion.
Got it. Okay. Thank you for the clarity. The other aspect is the investments. You've said in this at the end of quarter 2 with the releases that you've given that the investment continues in manufacturing capacities for cable, Lloyd, and lighting. I'm just trying to understand, based on the fact that, as you said, we are globally linked and the global markets seem to be a bit soft, save for maybe the recent data from China or US or maybe India is doing okay. But otherwise, the rest of the world seems to be in a bit of a limbo when it comes to growth. Do your investment decisions get impacted majorly by this? Are you going a bit slower than what you otherwise would in your investments for all your capacities?
Not really. I think from a demand perspective, and again, I'm not speaking short term here, in the medium term to long term, they're quite optimistic about the demand scenario in India, both on the consumer side as well as the... So maybe, one can say the capacity expansion may be a bit faster than required, but the fact is that we don't slow down, so that over a longer period of time we'll definitely see the demand coming up in India. Just the sheer demographics, the per capita expansion in incomes. I think overall, medium term, it looks good.
Got it. Last maybe one or two questions, if you will. One is the ECD segment. I can understand because of the festive season postponement. Maybe we'll see an improvement. The issue that most notes that I've read this morning seem to have is with the growth or the margin performance or the volume performance in the wires and cables side, even relative to some of your sized peers in the market. What's happening out there? Is there something that you believe you need to fix, or is this going as per plan and there is a method to the madness?
So one of the things which need to be fixed is the capacity for underground cables, which is still a smaller business for us. About 40% of our wires and cables business is underground cables. And that's where actually the major growth is coming because of the infrastructure spends. So once our Tumkur facility in Karnataka comes up, in the month of April, May, then we should see expansion in revenues on the underground cable side. Domestic wires business is doing fairly well. It's affected a little bit by the consumer offtake in the first half, but we should see improvement there in the second half.
We'll wrap it at that, Mr. Gupta. Thank you so much for taking the time out and giving us some sense of what's happening in the quarter as well as slightly medium-term plans. Viewers, thank you so much for tuning in.
Hello and welcome to BQ Prime. Joining us today is Mr. Arun Agarwal. He's the Chief Financial Officer of Mastek. He's speaking to us a day after the company reported its second quarter results, where the revenue rose up to 4.4% in constant currency terms, but the margin declined slightly quarter on quarter to 13.34%. The company has also completed the acquisition of Biz Analytica, seemed crucial to its business. Mr. Agarwal, welcome to BQ Prime.
Thanks, Tushar. It's my pleasure.
My first question to you, sir, is that you have clocked a constant currency growth of 4.4% sequentially in Q2. What is driving this revenue now, especially when other companies have said that they're seeing a delay or a lag in the conversion of deals to revenue?
Yeah, sure. So again, as an industry phenomena, I think all of us are facing the same challenge. There are delays in the decision making. The deal cycle has elongated. More decision makers has got involved, and I'm sure as the macroeconomic environments are there and the caution continues. However, the kind of investments we have made in last 2 years in our strategic area of pockets, we see deal momentum continues. Like Q1 was very strong in terms of order booking closer in the US as a market, and that is reflected in our quarter-on-quarter growth in revenue for the US business, right? However, in Q2 when we came, we saw again good closure of the order booking in the UK public sector specifically, and it was across UK but predominantly in the UK public sector. So again, that gives further confidence back to us that while the delay continues, but there are pockets of our strengths where we are seeing the deal conclusion happening, and that drove quarter-on-quarter 4.4% constant currency growth. And be noted, because this includes in-quarter consolidation of Business Analytica, which we have consummated from 1st of August. So there is part because of that. However, on INR terms, 5.6% quarter-on-quarter is our console. In organic terms, roughly 2.7% is excluding Business Analytica. So organic-wise as well, we are seeing the growth, as I mentioned, driven by the order book momentum, which we have seen in our US business, and now we have seen our UK business as well.
Okay. That is fine. Now, how do you see the rest of the fiscal panning out? Do you see these delays continuing? What is happening on the discretionary front? Are the discretionary deals coming in now? Do you think they'll come in the near future?
In terms of sentiments, Tushar, yes, there is a concern, there is a cautiousness, and we believe those caution will continue. Delay in deal cycle will again continue because still the macroeconomic environment, the concern, the rate of interest, inflation has not gone away, right? So that will continue. We feel confident. We are positively, you can say, we are cautiously positive because something which you don't control is the market. But our pipeline continues to be very strong. There are good deals which are up for conclusion in quarter 3 and quarter 4, which keeps us excited. If what we have done in H1 and we continue to repeat in H2, we feel as a Mastek will continue to deliver growth quarter-on-quarter and year-on-year.
You think you'll match the first half's performance in the second half as well?
We want to do it better than H1, Tushar.
Okay. Yeah. Okay. Because traditionally the H2 is the weaker quarter for Indian IT as compared to H1. Anyway, so your margins are down. So you have clocked an EBIT margin of 13.34% in Q2 from 14.79% in Q1. I'm assuming that's due to the wage hikes that you have given out during that quarter. What is your EBIT margin target for the full fiscal, and what are the margin levers in play for you to achieve that target?
Yeah. As you rightly said, the quarter-to-quarter margin dip is because of wage hike. We have done across company effective August. So there's 2 months impact, roughly 130 to 140 bips, which has impacted our EBIT downside. There's also consolidation impact of Business Analytica because the margin profile was lower, and that we mentioned at the time of acquisition as well. So there's 30 to 40 bips dilution which has happened because of that. However, there are operating levers which is helping us to mitigate the impact partially. We continue to look up to those operating levers. Some of them are great mix rationalization. They are commercial excellence. How can you better manage your resources linked to the billing which you charge to the customers? There's subcontractor replacement with the employees. Like this, there are other operating levers, including offshore-onshore mix, which we are working upon. We believe the margin will consistently improve between quarter 3 and quarter 4. And we are targeting to end the year with a similar margin profile which we had in Q1.
That would be around 15%?
Broadly in that range, yeah.
Okay.
That is, we want to end the year with that kind of a margin profile so that we can continue next year as well. And that should be again, operational excellence, which you need to drive. And the advantage is we have given the wage hike now. So we are out of that question, whether any further impact is going to come down the road or not. So that one is done. Now it's the operating levers which will drive the improvement.
Finally, you have completed the acquisition of Business Analytica. What are the synergies that are already flowing into Mastek? What is going to happen in the future? What are your thoughts on the Business Analytica acquisition?
It's a great acquisition, very strong capability in data cloud modernization with an angle of AI embedded into it. Already we have seen strong conversation both in our existing clients because the clients are excited when we are bringing the capability of Business Analytica into our existing customer base, whether it's a Snowflake, Databricks, bespoke development as a combination in the data cloud AI modernization space. So we are seeing a lot of excitement both in the existing space. At the same time, the client base of Business Analytica was really strong. Very good Fortune customer base, where we see a lot of mining opportunity for Mastek as well. So a lot of work needs to be done. It's just 2 months, but we are integrating the sales team. We are looking into the profile of the customers, building the relationship out there. How can we take data practice into Mastek customers and Mastek practice into Business Analytica customer, right? So that is a win-win on both the sides. Even what we have done, we have taken this capability when we have already launched, and we have taken this capability to our UK market as well. Again, it's at the nascent stage. We just started in 2 months, as I mentioned, but we are seeing a lot of excitement building up in the other markets as well. So while it is US-based acquisition, but it will be a global capability for Mastek.
Okay. I'm sure you must have also estimated how much the BizAnalytica acquisition is going to add to your top line.
As I said, roughly when we acquired the company, it was roughly $14-15 million annual run rate organization, right? So roughly $3.5 to $4 million run rate. But this business is bound to grow significantly, because any customer you go to, data is the ask, because that helps you in decision making, right? Decision making. So definitely this particular service line will grow faster than the company's average. Again, we are excited, Tushar. More and more growth to be visible in this area.
All right. Thank you, Mr. Agarwal, for joining us today. It was a very insightful chat about Mastek and the future ahead for the company. Thank you, viewers, for tuning in. This is Tushar for BQ Prime.